Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about STEM Inc. and their earnings preview. They are going to be announcing earnings later this week on November 2nd. That is going to be a Thursday. They're going to be announcing after hours at 5 p.m. Eastern Time. We will be covering those earnings live here on the channel. Now, in terms of what to be looking for, what we're going to cover, this is a stock that has had a very rough 2023. They broke out, or rather they broke through the prior low as of last week. You can see, again, it was a big hit. Again, a lot of the Russell 2000, which is the smaller companies that make up the stock market, did hit new lows on a year-to-date basis. Again, this broke out what we saw in May after a very strong earnings. And my expectation is that this is going to be a very crucial level and a very crucial earnings that's going to be coming out this month. Again, looking at the 3-year basis, so this is really covering the entirety of STEM as a publicly traded company. You can see that this is the lowest that the stock has been, and you're seeing this with a lot of smaller companies. Now, some of this is associated with the company's continued performance in terms of not transitioning to a software heavy revenue at this point in time and focusing on some of those hardware sales, which from a company perspective should pay dividends in the future, and hopefully that'll begin this quarter. But this is going to be key to watch, recognizing that the stock performance is now at a $3 level compared to where they were at the beginning of this year. So on a year-to-date basis, again, they were north of $10 a share, and it'll be interesting to see again once they add up and where they move. Now, this is a company that I think can move and move in a material way. Again, from a market capitalization perspective, they've been $1 billion company before. They are heavily held by institutional investors, whether that is the larger ETF holdings or rather when it is smaller family offices. I think that it is a large group there. And then you can also see that they continue to maintain a very high short interest, which I think could fuel should the company have a strong beat. So there are going to be a few things that we're going to be looking for, and I'm actually going to head over to their last investor presentation to talk about this. So this presentation came out at the end of September. I have a different video reviewing this presentation, but I'm going to be talking about what they stated they're expecting for Q3 and what I'm going to be watching on a go-forward basis. This is available on their website, and I will be happy to provide the link in the description down below. The first thing we want to see is that continued momentum from Q2. So backlog went up, revenue continued to go up year over year, bookings stayed strong, and that annual recurring revenue continues to be a strong component from a company perspective. And we also saw strong growth in a gross margin perspective. So what are we going to be looking for in a go-forward basis? The first thing is this adjusted EBITDA number. Now remember that adjusted EBITDA is not a metric that I like to look at because there can be a lot of fluff in those numbers. If we come down below and look at the financials, they actually provide their breakouts for the adjusted EBITDA numbers. So if I come all the way down here, the reconciliation for those GAAP and non-GAAP numbers in terms of how they're getting to those profit margins. And then down below, you can see how they're getting to those adjusted EBITDA numbers. So things like depreciation and amortization is a accounting terminology that they're going to be looking at. And then in addition to that, down below, you can see things such as stock-based compensation, which this year has still been quite material compared to what it was last year. The good news is I'm not expecting this number to go up materially unless the stock price begins to soar. And this is something that a lot of the management team will be continuing to watch. So despite all of this, the reason why I'm focusing on adjusted EBITDA is this is a metric that the company has said they will be positive in the second half of 2023. And I think it's actually absolutely crucial that they're able to announce a positive number associated with that. From a revenue perspective, if I scroll up here again, this presentation is available so you can review this. If you look at the full year 2023 guidance, they split out expectations of what the company is looking to achieve. And the main number that I want to focus on is this Q3 2023 metric. Again, over the past 2 earnings, they've come in slightly above expectations. They have a number of larger projects that they are expected to deliver in Q3 of 2023 as well as Q4 of 2023. And both of those numbers are going to be highly reliant on hardware deliveries. If both of these numbers can be achieved in a material way on the upper end, again, I don't think that we need a beat. I think the stock doesn't need a beat associated with this. We don't need to see 200 million. It's all going to be on that net income line and on this car line item right here. So the question is, can they show positive traction? Can they show that build on the cash? Anything under this 165 million, I think, will be a disaster, and I'll most likely have to just cap out losses at that point in time, because again, that'll be a point where the company is not meeting their expectations. So while we want to see bookings momentum continue to grow, which I think it is going to be positive, this is something that companies continue to invest in. I'm really going to be focusing on that revenue because they've got a massive bookings backlog. They need to deliver on that backlog, which is going to influence things like EBITDA as well as the car number down below. Because they focused on reaffirming that, I think we're going to have benefits. Again, this came out at the end of September, which basically was at the end of Q3. I'm optimistic on that. The following things that we want to look at, in addition to gross margin being strong, revenue being strong, is they've finally begun showcasing what the different metrics are from a revenue detail perspective. So you can see from a 6 months ended year over year for 2022 to 2023, the software side has only gone up by about, I say only gone up by 50%. This is going up in a material fashion year over year, but overall it is a very small portion of the overall revenue. Keep in mind, total services revenue here on a year-to-date basis is about 31 million. And if we're talking about the software side right here, solar and storage, you're talking about 28 million from a total revenue perspective for the overall company on a year-to-date basis of north of 150 million. So overall, still a very small percentage, and that's going to be what's actually driving those larger gross margins. And they showcase how those are broken out here, where you're not going to see that same level of margin on the hardware side compared to the services and the software. So there's a lot to look at here. There are a few additional things that I want to focus on from a company perspective. One of the things that we're going to be looking at associated with the cash balances is that going up? Again, we've been talking about the revenue side, the income statement side. Let's talk about the balance sheet side, and that's primarily going to be here in that working capital line. They had very small cash amounts, and the expectation is that cash is going to go up, and that's what I'm going to be looking for in Q3. Are they delivering on that? Are we seeing some of that accounts receivable line item go down, cash balances go up? And they did purchase all of their hardware in the first half of the year, so we would expect in the second half of the year for that to transfer to the revenue side and those cash balances to increase. So we want to be able to see that $150 million begin to appear in the Q3. So when we're talking about these numbers here, I've got to see cash balances go up. We've got to see revenue hit. Again, I don't think it needs to exceed to meet expectations. And we've got to see this adjusted EBITDA number be in a positive form. If not, I think the stock is going to be in a troubling position. If those three items hit, I think that the stock could have a pretty material pop where you could see it over the ensuing weeks move up back to the $5 range where it was not that far ago, which is important to note. That would be a large material hit, or rather a large material increase. But the difference is I still think that this is a very risk-on type of stock given the macroeconomic environment, as well as the fact that there are a lot of headwinds in the green energy space, and for any company that is not currently profitable. If they are able to turn a profit this calendar year from an adjusted EBITDA perspective with clear lines of sight to a GAAP net income positive perspective for 2024, and they are growing those software lines and they can get to 100 million or close to 100 million in recurring revenue, I think that's going to bode very well for the stock. That being said, I'm just some guy on YouTube, and there are very much still a lot of risk-on components of this. And as such, this is one that I'm going to watch, probably not going to play in a material way via covered calls or purchasing of additional stock. But let me know in the comment section down below what you're continuing to watch, what you'd like to see from this earnings, and I look forward to seeing you here this upcoming Thursday.